Yeah, the U.S. market has had a tremendous run over the past few years. It had a little dip in October of this year, but has bounced right back. And when we look at the market, the U.S. market today, we think it's a little bit overvalued, not tremendously so. So, it'd be a good time to maybe trim exposure. We think the valuations are not egregiously overvalued. So, I certainly wouldn't say sell. But it would be a good time to maybe think about trimming back. A couple trends in the U.S. that we've seen have been investing in income. So with interest rates so low, we've been in a 30-year bull market for bonds. So bank accounts, bond funds are just not generating much income, and so a lot of investors are pursuing dividend strategies, income strategies. And while that's fine, I think a lot of great strategies have been developed, one has to be careful that not to chase yield, because that can lead to going up the risk spectrum, investing in poorer companies, less financially sound companies that may have a high current income, but whose dividend might drop, or bond funds that are investing in more esoteric securities. So I'd be very cautious of that trend, but a lot of people chasing yield. So one of the trends we've seen in the U.S. is a flight to quality. So post-financial crisis, we've seen a lot of investors go after strategies that are investing in high-quality companies that Morningstar would term wide economic moat companies, firms with a competitive advantage. And while that's typically a good strategy, valuations have run up for those kind of companies, and so I'd be a little bit cautious about that. Again, I would not chase a trend just because that trend is positive. I'd be somewhat contrarian. So in addition to income-seeking strategies, that flight to quality has definitely been something we've seen over the past few years.